Hello, everyone. My name is Rada Milanovic, the Director of Investor Relations at Ginkgo. Thank everyone for joining us today. So we'll just give it another minute or two before we kick it off here. All right. So I'm showing 4:31. Thanks everyone for joining us here today for Ginkgo REIT's first quarter updates. Today I have with me two of my colleagues, Principal and Co-CEO Bill Green, as well as our REIT CFO Eric Stamp. Just want to remind everyone that we will be doing a Q&A session at the end of the presentation. So just make sure to drop any questions throughout the webinar in the bottom section of the chat bot. And also want to remind everyone that this webinar is being recorded. So if you missed anything or weren't able to join, we will be hosting the webinar on Ginkgo Vest and letting everyone know through email that it is live. So with that, I'll kick it over to you, Bill.
Thank you, Rod, and good morning, everyone. So overall, it was an exceptionally good quarter for us. We sort of hit on all cylinders, and not the least of which is you start with revenue. As you know, in North Carolina, particularly in Raleigh and Charlotte, we've been a little bit supply heavy with new deliveries over the last 24 to 30 months. And what you've had happen over the last 6 months is the peak of that has actually hit. And so about 6 months ago, the peak hit. We had overall occupancy in the regions of Raleigh and Charlotte declining. And but what we've found is the first quarter of 2025 is the first quarter where we have market-wide absorption, which means that people moved in at a higher rate than units were delivered, and that's the first time that's happened in a couple of years. Our overall move-ins have not really increased, but the movement to North Carolina and South Carolina remains just really strong. There was a noticeable increase. As we look forward, we also see a fairly consistent reduction for the next 18 months in deliveries that will actually get down to more normal levels of annual deliveries in about 18 months. So overall, our reaction to the market had been to worry a little bit more about occupancy and a little bit less about rent growth, and that strategy seems to have paid off. We're hitting the leasing season, which is really the months of May through August, with almost 95% occupancy across the board. That is a level that I don't really recall us ever being at this time of year. So we think we're actually in a really nice position relative to catching that wave of move-ins and having a little bit more pricing power than we've had recently. On the inflation and the expense side, we actually have our controllable expenses in a very nice spot. So controllable expenses are pretty much everything outside of taxes and insurance, and we had moderated growth there that Eric Stamp will get into a little bit more in his presentation. But again, we seem to be able to control what we can control. And importantly, it looks like insurance is going to be relatively flat, if not downward this year, given to excess supply coming back to the insurance and reinsurance market. So we do expect the second half of this year to again be moderated expense growth. With it, we spoke a little bit about this last quarter, and that is we're seeing the first opportunities that make sense in 2 years, and we're not seeing just a couple of them. We're seeing a decent sort of pent-up seller supply that's coming to the market. Some of that is specifically related to people that had short-term floating rate debt that is now coming due, that has significant debt requirement for a pay down that some sponsors can't meet. And so these undercapitalized sellers are coming back to the market prematurely, oftentimes at a loss. And we're actually seeing an opportunity, particularly there. But we're also seeing some people that might have been long-term sellers who just didn't know what to make of a very thinly traded market over the last 2 years, who are coming to the market. Uh, Oftentimes, these are older owners who are just looking for exits from their day-to-day business activities, and they want to get on with the retirement, et cetera. But it's more than just anecdotal. We're seeing a decent amount of that. So with it, we see an alignment of a good time to buy. Capital formation is tying to cap rates, and for us, this is really important that we can really push our capital raising and our debt raising to levels that allows for us to take advantage of this opportunity. But with it, we did close our first deal in 2 years in the first quarter, which is on the next slide. And this is a preserve at Pine Valley. It's in the Wilmington market. Wilmington is actually the leading, if not a leading market in the country relative to population growth over the last 5 years. And I think last year it might have been number one. Um, with it, this kind of fit the sweet spot of what we just described. It's 219 units. The prior owner had purchased this property in 2022. It was an out-of-market purchaser, not a bad purchaser at all. They seem very skilled in the renovation plan they did, where they renovated a majority of the units. But they just paid a very, very high price coming in, a sub 4 cap in 2022, in 2023. And that forced them to actually look for rents that really didn't materialize, and to get to the new cap rates. Their debt was coming due. It was coming due in March of 2025. We were able to purchase the asset at what we think is an attractive basis. And with that, we were able to actually buy the asset for virtually the amount of debt they had on the property. So they walked away, and they walked away from a decent amount of equity. To put in perspective, their basis was almost $42 million. In the asset, we paid $32 million. They walked away from $10 million of equity because they could not make a debt curtailment that would tie, which would actually wind the asset back down to a $20 million level. Uh, with it, the downtown Wilmington market is actually pretty vibrant, and it also had a little bit of supply issues. Those supply issues appear to be behind them. We're in the process of taking the occupancy from sort of historic mid-80s, where they had been operating the property for 2 years, and we're actually getting it back up into the high 80s right now. We expect to be in the mid-90s by the middle of the summer. Um, on a capital basis, we were able to actually put together this deal very effectively. We realized it was going to be difficult to finance given the performance of the asset and the lack of occupancy due to holding out for extremely high rents. And so we found a capital partner in JP Morgan Asset Management who was willing to purchase the deal all cash with Ginkgo REIT. So we entered into a 90-10 deal with JP Morgan, and at this point in time, we own it with all equity. We expect at some point, as does JP Morgan, that we will put debt on the transaction. We think it's accretive. That point has not yet arrived, but we do expect it to recapitalize that and pull cash out and redeploy the cash somewhere else. From an overall perspective, what does this do for our portfolio? This really starts to dramatically bring our leverage back into a more comfortable range for us. Even though we're in the mid 60s right now, mid to low 60s, we had been operating kind of the high 50s for a long time, and just given what's happened with values in general, that's crept up a little bit over the last few years. But with it, we have another transaction of a bigger size than this that we're looking at right now, that we're at a letter of intent stage right now. We expect that to be to contract shortly. And we do have 2 or 3 other smaller transactions that could hit in the third quarter. And the critical thing for us right now is we need to raise more equity, even though we will be looking and relying on joint ventures for a lot of this to augment our capacity to re-ramp up equity raising. We're really looking for you to help us identify people who might be willing to hear our story and anything you can do to help, I think is going to be really richly rewarded. With that, I'll turn it over to Rada, and he'll update you from there.
Great. Thanks, Bill. So I'm going to walk everyone through a couple IR updates that we've had in the first quarter of this year. Most notably, we finalized our 1099s filings for the REIT, and for joint ventures, we've also issued K1s. At this point, we're finalizing OP Unit K1s, which should be issued end of next week. So we thank everyone for your patience here. In terms of joint venture reporting, we've migrated that to Juniper Square. We've sort of deprecated File Cloud at this point, so we've centralized all communication, and hopefully improved a lot of the investor experience by migrating everything into Juniper Square. We are planning to continue to innovate on new products. One of the new products that we are looking to launch, hopefully in the next quarter, is our Series B fixed to floating preferred offering. So just on a high level, without getting into too much detail, that will provide investors with steady monthly income for an initial term, and then subsequently a floating rate that's pegged to SOFR. So that provides a protection against inflation. In addition to that, we have added a couple of, actually, a distribution broker-dealer partner called Alto Securities. They have already started to sell our REIT through their platform, and we're in discussions currently about adding additional offerings such as Ginkgo Notes. And as Bill alluded to, we continue to be in discussions with strategic capital partners. These are institutional private equity firms, for potentially large bolus amounts of capital to either recapitalize legacy assets or to help fuel growth through acquisitions. The type of investors that we're looking to partner with are, long-term oriented investors, as well as patient capital providers. A key theme that we've been focused on over the last year is trying to educate investors on what a well-balanced portfolio could look like. And we feel that investors could achieve that through short duration income through our Ginkgo Notes, but also longer term equity growth through REIT common shares. So on this slide, we're just comparing and contrasting the two different offerings. So just to touch on a little bit of each, Ginkgo REIT common shares offer higher expected returns, but this is slightly higher risk and higher growth compared to the notes. The notes are more stable, moderate return, and obviously lower risk. The dividends for common shares are paid monthly, where the notes are accrued and paid at maturity. The upside is unlimited for common shares, but with the notes, they're capped. And from a payment priority standpoint, Ginkgo Notes have senior priority over common shares, but are subordinate to the property level debt. And from a tax reporting standpoint, we're issuing 1099s, and minimums here are different. For common shares, it's 25,000, and for notes, it's 10 grand. So we think that this dual approach helps investors to manage volatility, has the potential to enhance yield, but also provides modularity in terms of investment time horizon. So taking this concept one step further, we have introduced the concept of laddering maturities based on liquidity needs, as well as what you feel is market outlook or market sentiment. Ginkgo Notes, as a reminder, we have the ability to offer anywhere from 3 to 24-month maturities. These are pegged against Treasury plus 200 basis points whenever we issue them. There are also yield enhancements at 100, 250, and 500,000 This is an example portfolio of a hypothetical investor here that has invested into a 6-month note, 12-month note, as well as the perpetual common REIT shares. And in this example, an investor might start off with a 6-month note and may want to receive the principal and interest back of the 6-month note. You can also reinvest the interest and principal into the common shares, or vice versa, redeem common shares into notes. So again, this laddered maturity type product provides flexibility, liquidity, and it supports both an income but also a long-term growth investment style. So with that, I will pass it over to Eric Stamp.
Yeah, thanks, Rada. I'm going to go through our balance sheet, then through earnings. I'll talk about some of our debt maturities that are coming up, and then lastly, I'll give an update on our NAV and share price. But taking a look at our balance sheet, we continue to think we're pretty well capitalized. We're heavily fixed rate. Over the past year, while we may have been a little slower on the acquisition front than we typically have over the past 3 to 5 years, the capital market side, we've been heavily invested in continuing to work on our balance sheet. Over 2024, we refinanced over $100 million of floating rate debt to fixed rate, and in 2025, we'll probably do more than almost 150 million, all joint ventured floating rate debt to fixed rate, as we to have those refinance opportunities with our partners. But with that, we're under a 5% all-in interest rate, and that includes the notes that Rada just went over. And our average maturity is on a little bit of a lower side, but you'll see as we get into our debt, this is well over 6 to 7 years when we take a look at some of the refinances that will happen through 2025. And then lastly, we continue to work on our leverage. Again, as Bill stated, we did a deal where all equity, and while we aim to be around 65% leverage, we're right around 63% today. So we think we're pretty conservatively leveraged, and we'll continue to kind of monitor that as we go through the year. As we look into earnings next, Bill alluded to a lot of this, but we had a really good strong quarter, significantly up from Q1 2024. A lot of this was topside, really much just stabilizing occupancy and really focusing on rent collections. I think, as Bill mentioned, some of the supply that we have coming on in the Charlotte and Raleigh markets, a lot of this was just taking a step back, resetting rents and really focus on getting occupancy up. And through the first 3 months, which we are generally a little slower for this industry, we're almost at 95, a little bit higher, 95 occupancy today. So all of this performance is generally topside. OpEx, besides real estate taxes, we basically were basically right in line with where we were a year ago. And most of the real estate tax and insurance is pretty much real estate taxes related, and insurance has kind of started to steady out. But with all that, and with an increase in interest over some of the refinances that have taken place, and as rates have kind of stayed relatively elevated, with 10% higher than last quarter, our net cash flow attributable to the REIT was almost 20% higher than it was last year, which flows down to our FFO of 16% per unit. So again, it was a really strong quarter. A lot of it topside as we kind of just stabilize occupancy and focus on collections. As we take a look at our debt, we think we're pretty well laddered. Again, we have a little bit of work to do in 2025 with some of our joint venture partners. We're already well into talks about what we're doing. It's basically just 2 assets, both with the same institutional joint venture partner. We kind of have a plan in place of what we're going to do later this summer to refinance these deals. And the exciting part is we're refinancing at a pretty higher rate. As you can see in the 2025 column, we're refinancing out of rates over 6%, and our weighted average rate, as you see at the bottom of the slide, is less than 5%. So we think we have an opportunity here to refinance all of this floating rate debt to fixed rate at rates less than 5.5. So After we kind of accomplished 2025, most of our debt, 2/3 is maturing over 2027. And anything in the next 3 years is all joint venture related. So from a wholly owned or consolidated standpoint, we're really well laddered. We'll continue to focus on moving debt, 7 to 10 years out, and continuing to focus on moving our floating rate debt to fixed rate. But again, for the first time in the REITs, since inception or since we kind of had joint venture assets, we're more than 50% fixed rate, and it's something we'll continue to focus on as we move forward and work with our joint venture partners. Take a look at this before we just get into our NAV and share price update. This kind of just compares what we are seeing in the market versus actual trades of sales trade up versus what we're seeing our appraiser value our assets on for our valuation. Over the past about year to year and a half, we look like we've been about 25 to 50 basis points higher than on our appraisal cap rates, which directly go into our valuation, and the your direct impact on share price. It appears they're elevated compared to what items they're trading at. I'd say the disclosure here is this is limited volume. A lot of this is under $1 billion in sales, which is less than our total portfolio. And a lot of the sales volume, it's hard to get actual information of the cap rates of some of the volume. Even in Q1 2025, it says there's $1 billion of sales. That cap rate is on less than 300 million of sales. But the one indicator that we do think we have is that we have one asset that's under contract right now. It should close within 30 to 60 days, and it's sold at under a 5 cap. Which I think can be really exciting for our portfolio because it shows that we have a lot of room. As you'll see on the next slide as we go in, we're at about a 5.4 cap on our total portfolio, which equates to the 136 current share price. And the board convened about 2 weeks ago and confirmed that the share price should stay the same at 136. Most of this was due to NOI growth. Even despite what we just saw on the last page, our appraisers had a little increase of our cap rates over the past quarter, about 5 basis points. We were at like a 535 cap, and now we're about a 541 for the total portfolio. But again, with that strong performance that we've seen quarter over quarter, driven by stabilizing occupancy, the board determined that there should be no change in share price based on the new appraisals we received. They also maintain the dividend at the same price, which is about 5.6% yield, again, paid monthly. A little bit higher when you take in our tax equivalent yield. Since inception, we have been 100% return of capital, all tax deferred. So no investor has paid taxes on our dividend, since inception in 2019. And then the outlook. I think the outlook from the last slide kind of says it. I think there's a lot of room where maybe we're a little bit more elevated on our cap rate than maybe what we're seeing transact, especially from seeing that we're under contract with a buyer that's paying on a T12 cap rate less than 5%. And with that, I think there's a lot of upside, especially with our joint ventures. Primarily, all of our joint ventures at this cap rate of 5.4, 5.5 is all pro rata. So we're not really receiving any of our promote or our performance gains that are inherited in those operating agreements as we enter those joint venture partnerships. So any downward movement is generally pro rata. It won't take as big of an impact to the share price as any increase in those valuations, where we will actually just inherit some of that promote, which will just drive share price. We think there's a really good opportunity to drive it tremendously and really provide some performance gains. So I think there's a really exciting outlook for what we can see on valuation going forward. And especially if we see cap rates just kind of normalize even to a 5.25, we think there's a lot of room where our NAV can have significant upside, which would be a direct impact on all of our shareholders. That's what I have for the NAV update and going through that. So I'll pass it back to Rada to kind of wrap up.
Yeah, thanks, Eric. Appreciate that summary. Let's see if there are any questions in the Q&A section. I am not seeing any. Understand that might not be an opportune time at 5 p.m. But just want to remind everyone that we do have our contact information here. So if you do think of any questions um, as you view this on GinkgoVest or as it's being distributed through email, feel free to email us. I'm happy to jump on a call. Actually, I don't know if there's anyone. Oh, here's a. What is the average fundraising per month? I will say, maybe Bill, if you want to jump in, but it does range anywhere from a couple $1 million to a few $100,000 each month. I think a lot of this has to do with a little bit of seasonality. Candidly, the end of last year and specifically in December, that was a very strong quarter and month for us. And first quarter was a little bit on the lighter side, but we are continuing to add channel partners to help springboard some of the common equity capital raising. I will say also on the notes program, I mean, it is a newer product, but we have sold probably in the last 9 months approximately $12 million. So we're seeing a lot of strong demand there. And we are next month round tripping some of the note investors. So investors will have the ability to receive either their interest back and principal, or they can receive just their interest back and invest the principal into a new notes program that's coterminous with the maturing one. Or investors have the ability to reinvest both the principal and interest, or even add more to up tier. So again, it is a wide range of investor volume.
So I'll be a little bit more specific, Rod. Since commencement, we've raised approximately $1 million a month in equity of commencement of the REIT. But over the last few years, that number has been about $500,000 to $750,000 per month. As interest rates have risen, real estate in general has become not as popular of a class, et cetera. With it, the trend seems to be trending a little bit more in our favor. Retail investors are starting to come back to the space. And so we want to capture that. As Rada indicated, our notes program is more of a quarterly program. We're averaging almost $4 million a quarter. Realistically, between our common equity and our notes program, we'd like to get our common equity back up into the $2 million range, and that's sort of a goal for over the next 12 months. If we can do that, we will we'll actually be able to line up pretty well with what we think our joint venture equity would be. And relative to our notes program, we'd like to be able to, at this point, really just sort of roll our notes. If we can roll our notes at $3 to $4 million per quarter, we don't need a tremendous amount of growth there. We don't, but we do need to maintain a level. And so that's great. But what you don't see and what we don't talk about as much is two other elements, and that is we do get a lot of contributions. Our contributions have averaged a little bit north of $2 million per month, and that comes in two ways, but it always comes in episodically. And by the two ways, it was contribution of existing partnership interests in Ginkgo deals, plus also third parties coming in on 721A elections. Those continue. We continue to have conversations about potential sellers who want to contribute assets. And when that occurs, oftentimes that asset will come to us with very, very low leverage. So we will get the equity contribution from that partner, at which point in time, at some point in the future, when rates might look more cooperative, we can actually extract some of that equity in the form of debt to actually use it to deploy to different assets. But the other element is our joint ventures. We have $350 million of joint venture equity that's co-invested with the REIT at this point, and we in this market, that institutional equity has been a little bit more willing to come back to the market quicker. And so we don't think we're going to have any difficulty raising 80 to 90% joint venture equity to partner with the REIT equity, but we do need to raise equity in the REIT side. So to put it in perspective, with our first transaction with JP Morgan, we got $30 million. On this next transaction we're looking to do right now, which is more of a portfolio, we have a partner that's soft circled for around $40 million, where the REIT will have to come up with its $4.5 million. So the joint venture equity looks like it's come back quicker, and our real focus right now is to maintain our pace on the notes, but also, you know, how do we get people to understand the good story we have in the future we see with the common equity.
Great. Thanks for filling in the gaps there, Bill. You see that Mike DeRiso added that good update. But yeah, I don't see any more questions coming in. So with that, yeah, I just want to thank everyone for joining us here today. I don't know, Bill, if you have any sort of parting thoughts or anything else to add before we wrap up.
Now, look, thank you for your time, and we apologize if we call you to see if you have anyone who might have interest in speaking with us, but we really are looking for it. We really do see opportunities right now, and as we started 6 months ago, pushing on the technology and channel partner side, and that's starting to bear fruit. We want to get back to individual one-on-one conversations. We find that to be very fruitful. We think we're an asset class that people don't have exposure to, at least not in our format. And we thank you for participating today.